So let's get into it, Matt.
Yep.
I want to talk about the macro uncertainties, the economy, and we first have to acknowledge the futility and even trying to forecast
Yep.
and predict the future. We don't know, but we can look at the signs. And the signs today, I'm not saying in a couple weeks, but the signs today are relatively troubling.
Yeah, and what was interesting about this report is it started at a time in which the markets had not been flashing the recession signals that they are now, and one of the inspirations of this report was some messages that we'd been receiving from investors about their own opinions about where the market is heading, and there was some trepidation, there was some worries that our investors were maybe ahead of the market, as they often are.
Yeah, well, if you talk to a lot of commercial real estate professionals and investors, they tell you that we've been in a recession, and specifically just talking about commercial real estate. I mean, with sales volumes being incredibly low over the past several years, asset values have declined anywhere from 15 to 30% in some cases, depending on the markets. Rent growth in case of multifamily has been negative for most markets across the United States. It's still very negative in the South, the Sun Belt. It has been positive in the Midwest, in the Northeast. But the reality is that a lot of multifamily investors, they're experiencing distress in capital calls. It's widespread. We talk to investors every day, and it's a shocking percentage of them, those who invested in deals over the last couple of years, that are currently facing capital calls. And what that tells me is that, those capital calls are in progress. And some of those capital calls will be successful, and, the proverbial can may be able to be kicked down the road for some of those owners, some of those projects. The long-term success may be questionable. Not all of those projects will have successfully fulfilled capital calls. And some of those assets are going to have to find homes, whether it's going to receivership or just going to the market and taking a loss to those investors. And so, again, talking to multifamily investors who are going through this pain right now, we thought it was important to isolate the now and the reality of doing deals the last couple of years in 2022, 2023, because doing deals in 2025, the 2025 vintage deals and 2026 vintage deals most likely have a dramatically different outcome than the deals being done in 2022. And so it's challenging to compare the two, even though they're still apartments, they're multifamily deals, and so they look the same, but the fundamentals are quite different. So getting into the macro story, uncertainty is not a question. We're just looking at just the global uncertainty index. We're basically peaking back to levels that we haven't seen since the pandemic. And really, we have to go back to the European sovereign debt crisis to go back before the pandemic to reach a point in time where we were so uncertain about the global economy. Just economic policy uncertainty in the United States, it's spiking. It's not just a little bit of tick up. It's quite extreme. Again, we really have to go back to the pandemic in 2020, which we turned the entire economy off. We didn't know what we were going to turn back on, what it was going to look like. We were sending out stimulus checks. We have to go again back to the European sovereign debt crisis in August of 2011 to get back to a point in time. That's when Greece was was failing. I mean, the entire Europe was in question, and that was just in Europe. We're talking about the United States and the entire global order in terms of trade, fiscal policy, and monetary policy.
It's interesting. For global economic uncertainty, in 3 short months, it went from a reading of 234 to 460. And that's only 3 months. And in the same period, from October to February of this year, roughly the same period, U.S. economic policy uncertainty went from 109 to 334. So in terms of the multiple, U.S. economic uncertainty has really grown considerably.
And one of the reasons why we're focusing on uncertainty and sentiment so much is because so much recessions are often, and just markets in general, they're driven by psychology. They're driven by feeling. And when individuals and businesses are uncertain, it leads to less spending. It leads to less decisions being made. And that alone, even in an otherwise...
It's the risk premium.
Exactly. Of I don't know what's going to happen. You're rolling the dice.
Companies and investors will pay more for the certainty of something
100%.
than the uncertainty of something, whether it's like a loan, like a forward looking loan curve or something like that, or maybe it's the cost of rebar that went up earlier this year in anticipation. They were saying, okay, I'm willing to spend a little bit more because I don't know what's going to happen. I need that guarantee that the materials are going to be there, and so that's kind of happening throughout. And also, I wanted to just connect really quickly back to some of the nervousness that the CRE markets were feeling in the beginning of the year, was 10-year treasuries were more elevated. They're still elevated, not quite as high as they were before, but that's just going to be an interesting kind of X factor as the economy develops.
Yeah, well, and we could talk a lot about the 10-year treasury, whether it's, the Trump administration seeming to have a desire to get the 10-year treasury lower, which has a multitude of effects, because, that would be music to commercial real estate owners and borrowers, the ability to potentially refinance or to see a positive effect and downward pressure on cap rates to either sell or refinance. Now, the question comes, again, why will the 10-year treasury be lower? Why will interest rates be lower? Is it because we're just in a slower growth economy, we're achieving an immaculate soft landing, or is it because we're entering some sort of recessionary period or period of contraction of where we're just seeing such slow growth, so where we may have to make some discounts in terms of even some rent growth in the short term as well, and just the economy isn't in nearly as good of a shape. But the point that we're making is, again, some of the fundamentals, like unemployment is still low, wages are still rising. There's a lot of fundamentals, many of them lagging indicators, not leading, that would point to everything's fine. The economy's looking good, and we could get we get some new data or clarity on tariffs, clarity on economic policy, fiscal policy, monetary policy, where a lot of this negative sentiment goes away. But assuming that it doesn't, just that, again, the psychology and the sentiment can lead to reduced consumer spending, business spending, and that itself drives us.
No,
into
that's a good connection there. So sentiment is down. Inflation expectations are actually up, and that's probably from no one's surprise. The inflation uncertainty, as measured by the Fed, which measures the difference between higher and lower inflation expectations, I thought it was just these are uncertainty means it's going up, but no, the people just can't decide now, and that's been going up consistently, basically up from 3.4 to 4%, according to the New York Fed's numbers. And then those inflation expectations that you saw a moment ago, they jumped from 3.3 to 4.3 in February. That was the second biggest monthly increase and the biggest one since November of 2023. They, in the University of Michigan, are connecting it to the January 31st announcement of tariff hikes. That's definitely looming over the economy right now and other kind of government policies. But however you shake it, you're just looking at these numbers. People are expecting inflation to come up, and that is runs counter to.
They're also very uncertain about it. Because we were talking about yesterday. I mean, tariffs, you can draw a line to make them absolutely inflationary unless it leads to less spending. And the prices can be high, but if you're not transacting at those high prices, just things aren't being done in that low growth, and so it's what is the net result.
You've got to have that low so the ideal is have very low inflation and then growth, and then maybe the Fed funds rate could go down and then the 10-year Treasury might go down in that situation. But otherwise, if inflation does stay high, then maybe we'll need a recession or something, or an economic downturn or lower growth period in order to bring that 10-year Treasury down.
Well, and certainly the Federal Reserve isn't going to have the ammunition to lower rates. Most likely, you'll have to keep rates where they are, and maybe even hike rates a little bit more. And that would be. So again, when we have these exact scenarios we're going to talk about in just a second, we'll get into. But in the case where rates stay where they are, go higher, that all of a sudden forces some borrowers that may hand those keys back to the bank. They're not going to be able to refinance. They're not going to sell it at a favorable price. That creates a potential forced selling environment where additional volume of assets comes on the market, and it could create an opportunity. Even though that what I was telling Jay this earlier, asset prices have to come down or interest rates have to come down. Both can happen, but really needs to be one or the other. But truly, if interest rates come down, asset prices are going to stay where they are, or they're going to go up. But if interest rates stay where they are, or if they increase, we're going to see a further decline in asset prices.
Yeah, that's one of the things that I think I'm pretty confident about for in terms of like investor sentiment. Consumer sentiment mixes in with investor sentiment, I think, a lot, right? But I think if interest rates come down like they are projected to come down, and they are, and right now we're seeing projections for the federal funds rate, and actually the revised projections based on this recent economic downturn should have these going down even further than they're indicated here. But this is a fairly accurate representation here of rates going down. That'll get investors excited. Even if there is kind of a downturn in the economy, I think that investors will pick up interests, whether they're institutional or individual. I think that individual investors will be quite interested in transacting if interest rates, like 10-year Treasury, goes down.
I absolutely agree. So just, again, kind of trying to kind of sum up this, not a direct call for a recession, but just pointing to the evidence. Last month, released this month, but for February, the Atlanta Fed has a GDP now, and they are essentially estimating that the GDP growth in February was negative, leading to an annualized rate of negative 2.4%.
Yeah.
This is that first data point that shows, could we have been in a recession? And what we're not including in this is just, again, the technical aspect. We're talking about the psychology, but just the technical aspect of moving public sector jobs to the private sector.
Yeah.
And that in-between time, there easily could just be a technical recession from a rejiggering and a realignment of
that's a very good point.
National economy, but also kind of the global trade paradigm.
Yeah. Yeah, that GDP, I think that GDP announcement took a lot of people by surprise, and perhaps even the GDP, because they were like, or perhaps even the Atlanta Fed themselves, because they were like, this is just what the computer's spitting out. And I think that it is valid, and it has been persuasive for a lot of people.
Yeah. So again, just some of these key economic indicators. We've got negative estimated GDP growth. We've got unemployment rate that is pretty low, but it is rising. Inflation is kind of moderately slow declining.
Yeah.
And Fed policy, well, it's kind of a wait and see. I mean, then the risk and uncertainties, trade policy, tariffs, who knows? It's changing hour by hour, minute by minute. The political environment is also chaotic. And so what does this mean? We've laid out 3 monetary policy scenarios and have derived recession probabilities based upon those scenarios. And very quickly, because we touched on it, one is basically a base case of keeping rates current. The second would be gradual rate cuts, decline by 50 to 75 basis points. The third would be aggressive rate cuts, 100 to 150 basis points. But through our analysis, if the Federal Reserve keeps the rates the same and other underlying fundamentals remain as they are with negative sentiment, we're looking at a 70 to 85% probability of a recession in 2025. If we see some gradual rate cuts, we're looking at closer to 50-50, really 50 to 65%. If they do some gradual rate cuts, that's still a moderately high probability. Now, if they get into aggressive rate cuts, we can significantly reduce that probability of recession. There's so many more factors that go into this, but right now, that's the situation that we as investors face of a possibility of a recession. And we have to keep this in mind that others are going to be running to the sidelines. That clears out the field for us to make some opportunistic investments.
Yeah.
And again, when everyone else is just running for the hills.
Just to put it into context a little bit about probabilities here, currently the CME Group's FedWatch tool has interest rate expectations for the end of the year at 3.5 to 3.75. So right at that middle point, the higher end. So maybe they'll come down 0.75 according to these projections. And then the same thing for 10-year Treasury. They're currently projecting it to decline to 3.8%.
And who knows? They don't. I don't think that they know. But so at the bottom line, moderate probability of a mild recession, where there's negative confidence and uncertainty that may lead to reduced growth and investment activity. But we all have to acknowledge the futility of forecasting, the futility of trying to predict the future, and it's going to change day by day, minute by minute. Yep. But just that in itself, that uncertainty will lead to less decisive action and potential opportunities depending on which timeline we find ourselves.
Well, and like depending. So we've matching this uncertainty, and if there's stuff that you do know that other people are uncertain about, then that's where you can find that opportunity. And again, that's like one of the reasons why we had this report is we were seeing this uncertainty even before the stock market took a dive. We were seeing that uncertainty, so we were like, okay, what are the real facts? What are the real things that are years in the making that overshadow and give us a sense of confidence and certainty that overweighs the current temporary volatility and uncertainty?
So at the end of the day, we're not traders. We're not trading in and out. In fact, we're long-term value investors. We're active value-add investors who look to find intrinsic value and look to create and force more value by improving the assets themselves. And so, we're doing this for, 5 to 10 year hold periods. And so we always have to take a longer view approach. Again, it's easy to stick our kind of head in the sand because it gets scary out there. But if we're in the business, as you and I are, of making sound investment decisions for the long term, we have to use opportunities of volatility and relative chaos to find that value, especially in today's market where we're not really seeing much value. Again, cap rates that are low, close to 5%, even sub 5%, in an interest rate environment where the 10-year Treasury is still, at 4.25. That spread is just too tight historically, which indicates that it should widen at some point. And there is the recipe out there for that to happen, which is why we're excited for the end of the year.